Australia's largest poultry producer, Inghams, has lifted its full-year profit and reported its strongest earnings results since it was listed on the stock market in 2016. The net profit was $101.5 million and the total dividend payout was increased to 20 cents per share. But the chicken supplier is expecting poultry volumes in this new financial year to be slightly lower, which caused investors to sell the company on the market today. You can see Inghams shares slumped just over 20%. It was the worst performer on the stock market. I caught up with the CEO of Inghams, Andrew Reeves, a little earlier, and we started by talking about the share market reaction.
So we posted a very strong result, in fact, the strongest result since listing today. I think our outlook is a little more subdued than the market had hoped. We did provide guidance for the year ahead. And one of the things we were looking to help reassure the market on was there is going to be a change in the supply agreement we have with our biggest customer, which is Woolworths. We remain their biggest fresh poultry supplier, but they are going to reallocate some of that volume to other players in the market as a part of their strategy to diversify their supply risk. Now, that's a very manageable change. It will take place across the course of FY25. And again, we provided guidance to help give the market confidence that that is a manageable change. I feel that the reaction is somewhat overdone at the moment. And as we continue our communications and discussions with the market, I think we'll be able to reassure them that we'll navigate this change very effectively.
Yeah, you're expecting core poultry volumes to be up to 3% lower in this new financial year. Are Aussies really cutting back on chicken?
No, actually, the market continues to grow. And if you look at the year we've just finished, the market has grown consistently with population growth, and chicken continues to be Australia's favourite protein. The adjustment in our volume is just reflecting this change in our arrangement with Woolworths. We've already secured new business with other customers in the market. It's just a one-time rebasing of our business that we've just guided the market on, and we'll get back to long-term growth as we work our way through that.
Yeah, at the supermarket aisle, where is the competition coming from? Because the other proteins on the shelf are pretty expensive as well.
Yeah, well, certainly, if we look at our own supermarket volumes over the last number of years, they continue to be quite healthy. So consumers are shopping in supermarkets. They're buying chicken to take home to prepare meals. Where we're seeing the softness in the market is outside of those channels, in the channels that tend to service out-of-home dining, so quick service restaurants, hotels, cafes, and the like, where people have got discretionary spend, and that's where the demand is softer.
Yeah, I saw Collins Foods yesterday had a bit of a profit warning that they put out showing sort of softer spending in KFC restaurants. So are you really starting to see that as well across the quick service restaurant market?
Yeah, we've started to see that in the second quarter of last year. We were talking about that at our half-year results in February. That trend has certainly continued and probably will continue to some extent into this next financial year. We're hopeful if we could get some relief on the broader economic in front with interest rates, cost of living pressures, inflation, and the like, that we'll see a return to more normal growth in those channels. But it's certainly subdued at the moment.
Yeah, you mentioned inflation. Past few years, that's hurt a lot of Aussie businesses and customers. Feed prices have been really high for you guys for a while, but are those pressures finally starting to ease off?
Yeah, so they've been, prices for commodities like wheat and soy for the last 3 years have been at historic highs. Now, that's started to stabilise and moderate, and we're seeing some really encouraging signs as we look into the year ahead that they're actually starting to come off. So that would be very, very good for the business, and we believe that will play through, particularly in the second half of the year.
You mentioned you've announced this multi-year deal supply agreement with Woolworths, which includes a reduction in the amount of chicken you're going to be supplying them. Just explain the rationale behind this deal and how long it took to get the deal done.
Yeah, we've had long-term supply agreements in place with Woolworths for many years, and that's been very transparent to the market. The rationale, as we've worked through this with Woolworths, is really coming out of the disruption that they and we all experienced through COVID. And they've really said to us, look, we need to put some measures in place that shore up our supply risk. Obviously, they want to make sure that there's always chicken on the shelves. That's really critical to them and to us. So they've decided to allocate some of that volume that we've traditionally had to other players in the market to that end, to make sure that they've got supply security. That's really what's driving this.
There's also been outbreaks of bird flu this financial year. Now, I know it hasn't specifically affected Inghams, but has that had an overall impact on the poultry market in Australia in any way?
No, not that we can see. I mean, it did only affect layer hens. It was actually very effectively managed and controlled by both the industry and the government authorities. And it was, in fact, in the scale of things, it was a very small outbreak, but it's had no impact on poultry demand or poultry confidence.
And you obviously operate in both Australia and New Zealand. Which market is actually performing better right now?
Well, certainly, I mean, the trends that we're talking about in Australia are apparent in New Zealand as well. These cost of living pressures are in both markets. Our business in New Zealand had a fantastic year. They were very heavily disrupted through the COVID period. Labour shortages and key input shortages, but they bounced back really strongly in that business over the last year. They've posted an exceptionally strong earnings result, exceptionally strong volume growth, and they've been able to execute two very important acquisitions in that marketplace, which will really support our business in the long term. So, yeah, we're very happy with the New Zealand team's result.
Andrew Reeves, Chief Executive at Inghams, thanks for coming on the show.
Pleasure. Thank you.